Welcome to the Deep Dive. Today we're taking a look at Chevron, specifically through a recent article from the Motley Fool.
Right.
Oil prices have dipped lately, but the piece suggests Chevron is still, looking like a pretty attractive investment. We want to unpack why they think that.
Exactly. What's behind their confidence in Chevron's strategy? And just for context, the Motley Fool, they're a financial services outfit, right? Their whole thing is investment analysis, trying to make investing clearer for people.
Yeah, aiming to make the world smarter, happier, and richer, I think is their tagline.
Something like that. So looking at their take on a giant like Chevron gives us a good window into the energy sector and maybe investment strategy more broadly.
Okay, so our mission here is basically to pull out the key insights from this article. What's Chevron been doing financially? What's their outlook? And what does it mean if you're interested in energy or just, potential investments?
Let's do it. Where should we start? Maybe the recent numbers.
Good idea. So first quarter adjusted earnings, the article says $3.8 billion. That's 2.88 cents per share.
Okay, $3.8 billion. Now, how does that compare?
Well, that's the interesting part. It's actually down from the same time last year. Last year it was $5.4 billion, or 2.93 Dickens share.
Ah, so a drop. That definitely catches the eye.
It does. You see that and you might think, what's going on?
But there's a but, isn't there? The article digs a bit deeper.
Exactly. While it's down year over year, those earnings actually beat what analysts were expecting. The consensus was apparently around $2.16 per share.
Okay, so they did better than predicted, even with the lower headline number. That suggests some, maybe, operational strength.
That seems to be the takeaway. The CEO, Mike Wirth, is quoted saying something about continued strong execution and delivering superior shareholder value. So internally, they're framing it positively.
Right. It's not just about the absolute number, but how it stacks up against expectations and, well, their own goals.
And the article does mention some headwinds they were up against.
Yeah. What were those? Lower oil prices, obviously.
That's the big one. But also weaker margins on their refined products like gasoline and diesel. And apparently some unfavorable tax and foreign exchange effects, too.
So multiple factors pulling those earnings down compared to last year, not just the price of crude.
Right. It wasn't exactly smooth sailing.
Yeah.
Okay, so that's earnings. What about production? How much oil and gas are they actually pumping out? The article said overall production was roughly flat.
Flat, huh? But is flat the whole story? Sometimes that hides what's really happening underneath.
Well, according to the article, you're right. It seems flat because they actually sold off some assets, specifically mentioned Canadian assets. That sale obviously lowered their total output.
Ah, okay. So divestments pulled the total down, but were other areas growing?
Yes, significantly. And that's the key point, I think. The decrease from the asset sales was basically canceled out by growth elsewhere. Big jumps in a few key areas.
Like where?
Kazakhstan, for one. Their TCO project there saw a 20% jump in production. That's huge. Apparently, a big project called the Future Growth Project just wrapped up.
20%. Wow. Okay. Where else?
The Permian Basin, right here in the U.S., up 12%. The article credits investment and efficiency gains there.
It makes sense. The Permian is critical for them.
And also the Gulf of Mexico, up 7%, thanks to some new projects coming online, like Ballymore.
Okay. So TCO, Permian, Gulf, those are major growth engines for them. So even though the total number was flat, the core strategic areas are actually growing quite strongly.
Exactly. It looks more like a strategic repositioning, shedding some assets and doubling down on others rather than just treading water.
That puts a different spin on flat production. Okay, so production is strategically shifting. How about cash flow? Where's the money going? The article mentioned shareholder returns.
Yeah, let's talk cash. In Q1, they generated $7.6 billion in cash from operations. That's, the money coming in the door from their actual business.
Solid number. And after expenses and investments, the free cash flow.
Right, the free cash flow, which is what's left over for dividends, buybacks, debt reduction, whatever.
Yeah.
That came in at $3.7 billion. Now, that excludes some working capital adjustments, but still, $3.7 billion free.
And how much of that went back to shareholders?
A lot. $3 billion paid out as dividends. And on top of that, they bought back $3.9 billion of their own stock.
Whoa, wait. So $3 billion in dividends, $3.9 billion in buybacks. That's $6.9 billion returned in just one quarter.
Yep. $6.9 billion back to shareholders in Q1 alone.
That's pretty significant. No wonder the article mentions a lucrative dividend. What was the yield again?
It mentioned a recent yield of 5%. For income investors, that's definitely something to notice.
5% is quite high, especially for a company this size. Okay, so solid returns happening now. What about the future? Strategy, outlook, What does the Fool's article say there?
This is where it gets interesting in terms of forward-looking stuff. The article highlights a couple of strategic points. One is that Chevron spent $2.2 billion buying Hess shares.
Hess shares. Wait, isn't that the company they're trying to acquire?
Exactly. They bought nearly 5% of Hess's outstanding stock on the open market. The article interprets this as a sign of strong confidence that their bigger $53 billion acquisition of Hess will actually go through, despite some hurdles.
Putting their money where their mouth is, basically. Interesting. What else strategically?
Their debt level. The net leverage ratio is apparently quite low, 14.4%. Their target range is 20% or 25%, so they've got a lot of financial headroom, flexibility.
Low debt is always good. So financially flexible, confident about the Hess deal. What's the overall outlook from the CEO?
Pretty optimistic. Mike Wirth is projecting, and this is a direct quote, I think, industry-leading free cash flow growth by 2026.
Industry-leading growth by 2026. That's a strong claim. What's supposed to drive that?
Well, they're projecting an extra $9 to $10 billion in free cash flow by next year alone.
9 to 10 billion more. Wow. On what basis? What oil price are they assuming?
Good question. The article says that's assuming Brent oil prices are in the $60 to $70 a barrel range, which is roughly where they are now, maybe low end of that, but in the ballpark.
Okay, so not assuming crazy high oil prices. What projects are delivering that cash?
It's basically the momentum from those key areas we talked about. That TCO project ramping up in Kazakhstan, continued growth in the Gulf and the Permian, plus they're also counting on structural cost savings they've been implementing.
So more production from key assets plus running leaner. That's the formula for the next year or two.
Seems like it, relying on existing projects and efficiency, yeah.
Okay, so that's a projection. What about those share buybacks? They returned almost $4 billion in Q1. Are they keeping that pace up? The article mentioned something about caution.
Right. They are dialing it back slightly in the short term because crude prices have softened a bit. Brent's down, $20 or so from its recent peak?
Yeah, it has pulled back.
So given that, they're planning to repurchase maybe $2.5 billion to $3 billion worth of shares in the second quarter.
Okay, so down from the $3.9 billion in Q1, but still a substantial amount.
Exactly. And the key thing the article points out is that this $2.5 to $3 billion range still keeps them well within their annual target for buybacks, which is $10 billion to $20 billion a year.
Ah, I see. So they're just adjusting the throttle based on market conditions, not fundamentally changing the plan to return cash via buybacks.
That seems to be the message. Prudent management, you could say.
Makes sense. Now let's circle back to that Hess deal. That's the really big potential catalyst, isn't it? $53 billion announced late last year.
Huge deal. And crucially, the article notes that the cash flow projections we just talked about, that $10 billion extra next year, that doesn't factor in Hess at all.
So Hess is pure upside on top of those forecasts. But there's that issue with ExxonMobil, right, over the Guyana assets.
Yeah, that's the sticking point. Exxon claims they have a right of first refusal over Hess's stake in that incredibly valuable offshore block in Guyana. Chevron disagrees.
And how's that getting resolved?
Arbitration. They've agreed to go to arbitration, and the article mentioned a court date set for May 26th.
So a decision might be coming relatively soon, and Chevron buying Hess shares suggests they think they'll win.
That's certainly how the Motley Fool article seems to read it. That $2.2 billion share purchase is seen as a strong vote of confidence from Chevron's side.
And if they do win the arbitration and the deal closes, what's the impact?
Well, it's expected to be massive, significantly boosting their production, especially with those Guyana assets, and extending their growth in production and free cash flow for years down the line. It really changes their long-term profile.
Okay, so it's a potential game changer, but hinges on that arbitration outcome.
Got it. So let's try and sum up the main points from the Motley Fool's perspective here.
Okay. I think the core idea is, recent earnings were hit by lower oil prices, no doubt.
Right, the headline number was down.
But fundamentally, Chevron's strategy seems to be working, according to the article. They're investing in projects that throw off a lot of cash.
And they're funneling a significant chunk of that cash back to shareholders through dividends, that high-yield dividend, and also through those big share buybacks. And looking ahead, even without Hess, their own projections show strong free cash flow growth coming soon, driven by projects already underway and cost savings.
And then the Hess acquisition looms as this major potential accelerator on top of all that. if it goes through.
Right. So for you listening, it's kind of a case study, isn't it? How a huge energy company tries to navigate the ups and downs of the oil market.
Yeah, focusing on cash generation, shareholder returns, strategic investments. Even when the immediate price environment isn't, peak levels, it's about playing the long game.
It really highlights those complexities in the energy world, but also how companies aim for that long-term value.
And, thinking about Chevron positioning itself like this, navigating fluctuating markets, geopolitics, the energy transition, it kind of makes you wonder, doesn't it?
Wonder what?
Well, what other big established industries out there might be going through similar, maybe less obvious, but equally significant transformations right now? Something worth thinking about, perhaps exploring further.